In today's video, we are going to talk about IAS 8, the selection and disclosure requirement in accounting policies, and changes in accounting estimates and errors. So, what exactly are accounting policies? There are principles and rules applied by the entity in preparing and presenting financial statements. For instance, there are different ways of measuring inventory or recognizing revenue. When selecting which policy to use, you have to first determine whether there is an IFRS available relating to the transaction or event. If there is, simply apply it. If there isn't a specific IFRS, we use professional judgment, and management should use other resources in the following order. IFRS that deals with similar and related issues. If that's not available, then use conceptual framework definitions, recognition criteria, and other measurement concepts. Then, consider other standard-setting bodies that use a similar conceptual framework or other literature or industry practice. The aim of this is to determine the most useful, relevant, reliable policy through professional judgment. Now, let's talk about policy consistency. We should use the same policy for similar types of transactions. You can't measure one vehicle at historical cost, and for another vehicle that's used for the same purpose, you measure it at fair value, because consistency allows for comparability between periods and your asset classes and with other competitors. IAS 1 states that a complete set of financial statements include notes that comprise of a summary of significant accounting policies. This will allow users to compare financial statements and policies used between different entities. But also, it's required because sometimes accountants can't be trusted. They might choose the policy that looks the best in the books. So, by disclosing those policies, at least users will pick up on the poor policy choices. So, we need to know the measurement bases and any other details that are important. Although we talked about policy consistency, we don't always force consistency if changing it will give us more useful information. So I've created a flowchart to help you understand when you can change the accounting policies and the adjustments you have to make. There are two reasons when accounting policies can be changed. Sometimes it's required by the IFRS to change to new policies, so that's when it's forced upon you to change it. But sometimes you might decide to change policies just because changing it will be more relevant and reliable. For instance, if you have been valuing inventory using the last in, first out method, you can change it to the first in, first out method as long as it's more relevant and more reliable. So looking at the flowchart, does the change meet the criteria? If the answer is no, then no changes are permitted. If the answer is yes, and you're changing it because of a new IFRS, you must apply the transitional provisions, and it will document what disclosures you have to make, such as going back in time and adjusting accounts so it's comparable. And if you're changing the policy because information will be more relevant and reliable, so there's no IFRS transitional provisions, then you have to determine whether it's practicable to apply the changes retrospectively. You might have heard the word retro before when someone says, clothes look retro or a retro style. It means a style from the past, the 70s or 80s. So in accounting, this means that you have to go back in time and update the previous year's accounts so users can compare the figures between reporting periods. You do that by first adjusting the opening balances of each component of equity and then restate the comparative amounts, so the income and expense items, etc. But IAS 8 recognizes that sometimes it might not be practicable to do so. For example, the data is no longer available. In this case, the new accounting policy must be applied from the earliest date practicable. When we change accounting policies, another thing we have to do is make disclosures and explain why. For changes due to the application of IFRS, you have to give details of the new IFRS policy and the effects it has on your entity. For voluntary changes, if you don't really have a good reason as to why you changed the policy, it might seem a little dodgy. So explaining why a change in policy provides more reliable and more relevant information helps prevent accountants from abusing that. So now let's move on to accounting estimates and correction of errors. The financial statement involves a lot of uncertainties, so accountants are always making estimates using professional judgment, such as the amount of bad debts, the fair value of assets and liabilities, warranty obligations, and so on, because we don't know the exact figures. But as new information is received, the estimates may have to be revised. So when we change estimates, it doesn't mean that the previous one is wrong, so we don't have to recognize this retrospectively, meaning going back in time to correct previous periods. We simply have to recognize it prospectively, meaning the current and future periods. So the previous estimate was correct at that time, and now we're just updating the figures. In terms of what adjustments to make, for income and expenses, profit and loss, we adjust the current period or the current and future period if the estimate affects the future, so it's prospective. And for the balance sheet items, adjustments should be made in the current reporting period where the estimate has been changed. The last topic we're going to talk about is when mistakes are made. And IAS 8 acknowledges that this may happen, such as mathematical errors, applying the wrong accounting policy, oversights, misinterpretations, or even fraud. So IAS 8 states that your financial statements do not comply with the standard if there are material errors, meaning they are significant, or deliberate immaterial errors. We're all human and mistakes may happen, but what do we do when we find out about the error? You are required to make adjustments retrospectively, meaning going back in time and fixing the first set of financial statements issued after the error's discovery. So as soon as you find out about the error, you have to fix it. You can correct this by either restating the comparative amounts if they relate to the affected reporting periods, so you have to go back in time so the comparison is valid in financial statements. And if it happened a very long time ago, like 10 years ago, you're no longer reporting those figures in the statements, so you might only have to update the opening balances from a year or two ago, even though the error dated back to 10 years ago. So, restating the opening balances for the earliest period presented. If it's impracticable to determine the error amount made in the prior period, then you make a prospective adjustment, fixing the error from the beginning of the current financial reporting period. So it's quite logical. Go back as far as you can to correct the error, and if you can't, adjust it now and do the best effort you can. And remember to clearly disclose the issue, the nature, amount, etc. Thank you for listening, and I hope you now understand the concepts of IAS 8, accounting policies, changes in accounting estimates, and errors.